should say, of course, before we go further, it's not in the bag yet. I mean, it's not a preliminary takeover approach. It is a formal sort of legal document that came out, and in my experience, these nearly always actually go to fruition when you get that extent of sort of legal work having already been done. But it's not guaranteed. So there's still a possibility if, you know, something is discovered at a late stage, the bidder can still pull out. So, so just really for some general, so I don't want to be too triumphalist about this in case it falls through. So, show of hands, I thought, more out of interest, first of all, just curiosity. Did you hold Avesco shares when the bid was announced? Just so we can get a rough idea. Okay, looks to be about a quarter of the people in the room. So well done, all of you. Second question, have you sold? I'm going to put my hand half up because I actually sold about 2/3 of mine today because the price has got so close now to 650. I got 639 for mine, and I took a view, well, you know, I'll let someone else have the last 1 3/4% just to be sure the money's in the bag. And obviously there's an opportunity cost as well to having that money. I can now do something with that and hopefully not lose it before before I otherwise would have been paid out. So, and final question, was or is Avesco a major shareholding for you? And I'm going to sort of put, is it top three? Top three? Nobody. Gosh. No, it wasn't for me either. And that's one of the key things I want to draw out of this talk, is that I think sometimes we don't see the woods for the trees in terms of maybe concentrating our money in ideas that really actually at the time looked obviously underpriced. So this talk isn't hindsight. This is all drawn from stuff I actually put in my blogs over the last 2 years. And there have been other bloggers who've spotted it. Michael Mouse, his blog, he's been very bullish on this stock for much longer than me. So I'm not claiming ownership of this success. Plenty of people spotted the share. So what I've done here is crammed as many important points onto the last 3-year chart as I could fit in without making it illegible. And I'll publish all these slides online, so don't worry too much about having to sort of jot everything down. There was, in my view, a sweet spot sort of around late 2014 to early 2015 when this was a complete no-brainer, when the information in the public domain made it just crushingly obvious if you read through the RNSs properly, that this stock was dirt cheap. I won't go through all the RNSs, but the good news really started to flow in early 2013 off the scale here, where the dividends were reintroduced after a sort of 2-year hiatus after the financial crisis. And if you look, I'll show you the progression of dividends in a moment. Then in January 2014, it's only a tiny blip on the chart now, but that was actually the special dividend payout relating to the Disney compensation win, which was a huge amount of money at the time. I think it was a special dividend of about £1.10 a share, roughly. I can't remember exactly. Now, at this point in December 2014, that's when we got the really first sort of pivotal trading update, because the company had engaged in a fairly major restructuring. There were lots of different parts of the business, a lot of which were quite significantly loss-making, and that was diluting away the profitable parts of the business that were being disguised. So if you look at the overall results up to about there, they were pretty awful. You know, it was loss-making or even break-even. Didn't look very exciting, but as I'll come on to later, you know, no business is really the sum of the parts. You can actually shut down loss-making parts of most businesses very cheaply and easily, which can then unearth tremendous value in the profitable bits. And that's one of the key things I look for. So these are quotes from the RNS. So ahead of expectations, Q4 extremely busy, particularly strong Creative Technologies USA. Now this is a theme that comes out through all the outlook statements over about the next 2 years. In every outlook statement and every trading update, they say how strong trading is in Creative Technologies USA. So, you know, and it gave figures. It said revenues up 18%, profits are soaring. Well, I didn't say soaring, but you get the drift. So again, all the information was there. Then shortly after that, again, in March 2015, we had another positive trading update, comfortably ahead of directors' previous expectations. So their previous expectations were raised only 2 months earlier. So again, I think when you start getting a bunching together of upbeat market expectations performance, you know, that's a very bullish signal, I think. Right, now this, we really started to motor here. strong interims. It was starting to become clear that the restructuring had worked. Also, big director buys. We could debate director buys as a topic for hours, but I mean, my view generally on it is that I think all too often these days it's used as a PR stunt. So if they're smallish buys, I ignore them, or I would regard those maybe as even a negative thing. But when you see really chunky director buys, you know, rule of thumb, if it's into six figures in terms of pounds sterling, I think that's not a PR stunt. That's somebody knowing that good things are in the pipeline. So all these factors are coming together here. We then got this really quite long period where I think, I was talking to Tamsin just before we started, a lot of people I think over that period of time just got bored and sold out. And that's, again, one of the dangers with this type of stock. The market is not rational with smaller caps very often. And then here you had disposal of the freehold property, which was Fountain Studios, where X Factor is filmed. I think, well, several friends, but including David, flagged this to me, in that it was, I think, a 3-acre site or something. And I think you, David, and Panos, you know, get onto Google Earth, do a bit of sort of general digging with your property knowledge, and these guys discovered that an adjacent site had sold for about £6 million an acre. Well, this property was in Avesco's books at cost, about £6 million. So there was basically £10 million of free money sitting there if you did a bit of Googling and found out that property was worth a lot more than book value. So that, again, is something that David's done for many, many years, and very successfully, because it just all helps put the odds more in your favour as an investor. And I just added
Paul, what's the time scale along the...
Oh, sorry. That starts at January 2014. So it's 3 years, basically. So, yeah, November 13 there, sorry.
So when the first big step up was how long ago?
Well, it was hovering around sort of £1.20 around that area. That was the first big step up, I suppose. Here was really April 15, really, when it went from about 120. That's when it sort of really started to break out upwards. And then I put at the bottom just the market cap, roughly tying in at 6 months intervals. And you can see that at this sort of level, the market cap was only 21.9 million. Well, they got 16 million for a surplus freehold there. And actually, Fountain Studios was losing money. So it didn't harm the business in any way, getting rid of the freehold. It actually improved profits as well. So again, just free money sitting there for people who did the digging. The only glitch in terms of the RNSs that I found was this one here. Some interims came out, and they said the phrase "slightly disappointing" is what the actual chairman used in the RNS. But they gave reasons for it, which didn't sound particularly worrying, apart from, I think they mentioned possible pricing pressure, which did slightly unsettle me at the time, actually. I look back at my blog post there, and I basically said, you know, I'm a little bit confused by these results. I'm going to have to do a bit more digging. But as has previously been the case with Avesco, they had a really, really bullish outlook statement. So I decided to hold, even though for a company where, and what the chairman says at this company has always happened, you know, so I think you've got to draw a distinction between companies that are permanently bullish on everything and companies like this one, where actually if something goes a bit wrong, they're honest about it, and then you don't necessarily have to panic sell.
And Paul, can I emphasise that point? Because with the freehold in there, the other factor in deciding that an investment like that is worthwhile is that you trust the management.
Yes,
so
absolutely.
Establishing trust in the management
Establishing
is
trust.
crucial.
I couldn't agree more. And having the underpinnings with some freeholds in there as well, you know, you've got the balance sheet strength to catch it if it does fall. So yeah, good point. So yeah, very positive outlook statements. Again, this was just before the Rio Olympics. So they were saying, you know, we expect to do extremely well at the Rio Olympics. Sure enough, going back to the theme of the chair...
Sorry, is there any explanation why nothing happened with the share price when the 60 million freehold?
Good point.
I mean,
good point. I mean, you can
went
see
up
the
and
spike.
down. That means they all knew before, like you, or
I don't know.
Nobody had worked it out how much it might
Well, if you look
for whatever reason,
market cap,
it
it should have done about a third of it.
Yeah.
You know,
I mean, this goes back to the fact the market is not rational in small
In
caps.
small companies, you've hardly got any answers. So it's down to you and I to pick something up and work on it.
Yes. So I mean, you did have a temporary, but the spike up you can see there. That's sort of, then people just sold into it. Don't know why.
Did they pay that cash out?
No, it cleared nearly all the net debt.
Oh, right.
Yeah, so they had something like 19 million, I think, net debt. That reduced net down to 3 million. Of course, it's an equipment hire business, so it's got a lot of fixed assets that depreciate quite rapidly because they have short 2 to 3 year life, and then they fund that with asset financing. Well, it's now post selling the freehold. There's now negligible debt, so they own nearly all the equipment outright. Very, very nice situation.
So that reduces all your costs and ups your profit.
I mean, that kind of highlighted how cheap it was, presumably by comparison to other hire companies which had lots of debt.
Yes,
There
right.
was basically zero debt, so effectively you could, you could extract all that cash out of people.
Yeah. Or they could dramatically increase the size of the hire fleet easily just by taking on a little bit of debt. It just skews everything in our favour as investors, and still here we're only up to about 45 million market cap.
I mean,
I
does
think
that
it's now
explain
debt-free.
why the takeout multiple was so high? The fact that it was ungeared when it was, that's why that's how they could
Possibly
afford
that
to
might have helped. I mean, these are all factors that are going in our favour, but as you can see from the takeout price, which is the green line at the top there, this company was just fundamentally underpriced relative to what these guys eventually were prepared to pay for it.
Because the forward was about 10, wasn't it?
Yes,
When
yeah,
it
and
was
the PE
taken
never
out.
got above about 10 over the whole period of this. Anyway, so that's covered most of the recent history of it. This, I think, was the period when there was the most obvious share price anomaly, was December 14, January 2015. So I just thought I'd give you some stats on that. At that point in time, you had this trading update telling you it was ahead of expectations. Q4 extremely busy, particularly strong in America. The forward PE by this point is only 6.1. Dividends are rising, the yield is now 5.4%. So again, very obvious value. This wasn't something you had to really...
But was that because of the net debt figure at the time? What multiple?
Well, I mean, the earnings figure would be after the interest cost, and they're just rotating the debt as they buy and sell the equipment. So it depends how you look at it, doesn't it? Then you had shortly after that, just a month later, another even more positive outlook statement, again emphasising CTUSA. So you've got within this a business that's absolutely going bananas, but that's obscured by the other parts of the business. Just to keep this out, this would be too small to read, but it's basically a screenshot of the Stockopedia page on dividends, just showing them starting again at a penny, going to 3p, 4p, 5p, 6p, 7p in each subsequent year. Again, I wouldn't say that was a massive factor for me, but it's just knowing that the management are pretty conservative. It's just yet another thing that you could maybe put on a checklist and say each points like this just add additional sort of comfort. Now let's look at Richard Murray, who is the founder of the business and the chairman. He founded the business in 1984, so this thing's been around a long time. You can see from his sort of craggy features there that he's, getting on a bit. But I'm looking at that in business terms. I knew that one would ruffle a few feathers, but no, joking. Is a successful entrepreneur. He's created value from this business in other ways previously as well. I just got the feeling when I looked at this company over a period of time, he seemed a sort of entrepreneur that you want to back, And at that age, he's probably not going to want to continue with this forever, which means he's going to want to maximise the sale value, which maximises shareholder value. So doing a bit of Googling, he's also chairman of Charlton Athletic, been involved in that for about 25 years. Although, and of course, 27% shareholder in Avesco, so he's very much a controlling executive chairman. So he will steer the path. So you've got to make sure you're comfortable with the individual for these. I mean, David and Lord Lee absolutely love these founder/family-owned businesses, and I do too. I think they just have a much better long-term perspective on everything usually, and providing they've got a track record of treating outside shareholders decently, and paying reasonable dividends to everyone, not overpaying themselves too much. Although there was an issue with Avesco. A couple of friends of mine and a couple of fund managers I spoke to said that they're overpaying themselves, the directors, and so they wouldn't go near it with a barge pole. Now, I think that can be a mistake. I think none of us like directors who pay themselves massive salaries, but I think sometimes I'm coming around to the view that if everything else is okay about the business and its performance, I'm prepared to cut them a bit of slack on their salary, because I think if you're not careful, you can cut off your nose to spite your face. Now, I discovered last night only that he's just unfortunately been quite poorly, and he's been diagnosed with stomach cancer. So obviously, I know he can't hear this thing, but if he does hear this thing online, just want to wish him all the best to get well soon. But I think also that can perhaps change people's perspectives on life-work balance, you know, and what they want to do with their retirement and so on. So, and also the disposals, of which I didn't really touch on the last slide, but the disposals that they've done of the various, not just the freehold, but a couple of other loss-making parts of the business, to me started to point towards this thing being cleaned up for a trade sale. You know, you can maximise the value by getting rid of the bits that are losing money or have erratic performance. And it all started to point to me towards a probable trade sale of the business, which again is not hindsight stuff. I've put it in my blog several times. Obviously very pleased it's happened this quickly. Yeah, just to touch on the fact that again, as an individual, he's created value significantly before. There was a, I can't remember where it was. There was some, was it called Videologic or something, was demerged from Avesco, I think, in the 1990s, I think. And there were a couple of other episodes where he'd done stuff, you know, that was good for shareholders, which all gives me confidence that we're backing the right individual here. Now, pricing anomalies. So these are more just sort of other sundry points. So I think I've already touched on that. The 6.1 PE in early 2015. You do have to take into account though, the good year, bad year cycle that they used to have. So it was alternate years depending on some sporting events. Although again, buried in the narrative within the restructuring was that they were eradicating that seasonality by sort of just general upturns in the profitable businesses. Good and growing dividend yield we've covered. Freehold in for free, we've covered that. The other metric that it was always cheap on right the way through was price to net tangible asset value. Now normally the average for hire companies is about 2. Some go as high as 4 times. This one was on 1 or even below 1. So again, it was just more and more evidence that the thing was just fundamentally mispriced. Now, Stockopedia picked up on this again. I'm not here to promote Stockopedia, but obviously declaring an interest, I am paid a modest salary to produce the small cap value reports. So the stock ranking system I'm getting increasingly impressed with actually, because it does seem to have a good track record of picking up cheap, improving companies, and it picked up on this one from early 2015 and remained bullish on it right to date. So I do think the stock rank system is demonstrating very good results. So looking now over several years as well. So now looking at the jewel in the crown, CTUSA. So that picture there, you probably can't see it, but it's actually the Hoover Dam with a full screen. They turned this Hoover Dam into a giant projection screen, which we could have maybe not had the Hoover Dam here, but something in between that and the tablecloth. Yeah. So, but it's really spectacular. And I think when you see something game-changing like that, which certainly I'd never seen before, you do sit up and notice. So high and improving profitability, which I'll show you the figures on a subsequent slide. Losses in other group companies were obscuring the value. Another company that's very similar to that is OMG. I don't know if any of you have looked at that, but it had a very heavily loss-making bit, which dissipated a lot of the profits. They've done a similar thing. They've just decided to close down the loss-making bit. The rest of the shares, I think, at least doubled on that decision over a period of time. So it's a nice investing theme, this one, I think. Companies with divisions that have wildly different performance. So the Facebook and Twitter feeds for companies generally, I think, are worth following. Richard Straffen's very good on this. There he is, and Alan I know is. So people who are sort of tech savvy can often pick up very interesting facts and figures from. And you certainly could with CTUSA. It's got its own Facebook account, and it was showing contract win after contract win. You know, and impressive stuff with big name clients.
You mean because it's not a rampy type company, which would R&S every cup of tea they sold. Exactly. So these new wins are a lot of them are only on a company-specific newsfeed, like Twitter. Right.
And they may not be individually significant enough to warrant an R&S, but you know, put together, you then get several months later an outperform RNS. So I think it's all sort of adds weight of evidence, doesn't it? Now, what's this one? Some of the parts, no. So what I mean by that is saying I've taken the three divisions within Avesco here and shown there what the company calls trading profit, which is sort of pre-exceptional operating profit, I think. And I've shown them the last 3 years' accounts. And what you can see is that CT, which is not just the American business, there's a European division to that, which was problematic. But CT, if that was listed on its own, has gone from a 0.5 million profit to a 4.4 million profit to a 9.1 million profit. Now, you imagine if that division was listed separately and was given the full financial PR treatment, it would probably be valued on a market cap of about 150, 200 million or something. Yet it's buried within this group where the bottom line shows a much gentler progression from actually overall losses to, it looks as if profits flatlining, just sort of plateauing at 6 or 7 million. Well, actually, that's disguising this pretty stellar performance coming through from CT. Again, I'm repeating the same point over and over, but if you drill down to the individual divisions, you can often find. Now, the market will tend to value the company on the multiple of this figure here, the aggregate. But actually, what we should be doing, in my view, if there's going to be some catalyst to change the group structure, like a bid, we should be valuing these things at nil. Just ignore them; they confuse the picture, and actually look at what a proper rating for the growth part of the business would be. And you can often, well, as we did in this case, get a pretty stellar return. So other factors to note: these are just continued sort of bullet points. Repeatedly beating forecasts. I think companies like that are more likely to be undervalued because quite often the brokers will lag behind and the forecasts won't reflect very strong performance. Very quiet bulletin board is always a good sign in my view because it means that the stampeding hordes of rampers haven't found it yet. So that was certainly the case here. We've touched on that already, very high stock rank. I do think this stock rank is not a cure-all by any means, but it's got a good track record of picking up cheap, improving companies, so it's worth looking at. Now, this Avesco also did share buybacks. Generally, I'm not a fan of those because they seem to be used to mask the dilution from management share options very often, and also for shares at a massive premium to net tangible asset value. Why the hell would they be buying the shares back? But where you get something that's on a P of 6 and trading below net tangible asset value, I'm very happy for them to use surplus cash to do share buybacks. And if you look at the number of shares in issue over the last 6 years, it actually fell quite significantly from 25 million to 19.2 million. Again, not something you see very often. Sterling weakness obviously has boosted the value of this company because actually more than 100% of its earnings are in US dollars. So that's been a very significant factor lately.
Isn't there another potential point on that, which is basically if Trump cuts the rate of corporation tax for US from 35 to 15, then that could have been potentially one of the things that sealed the deal.
Yeah, I agree. I mean, I think as David flagged up to me on Friday, there seemed to be an increasing amount of deal flow from American companies buying up UK companies with dollar earnings. So I think this is a really, really good investing area to focus on at the moment, definitely. What else has we got on here? Oh yeah, trend of US companies buying up UK companies.
Trump's also proposing to let companies repatriate the massive funds they have abroad for a one-off tax payment, which would leave them with more cash.
Give them more firepower. Yes, I agree. Last point here was spot obvious trends. So this is the Peter Lynch theory that he focused on a lot in his book. Just looking around you and watching what's going on around you, and just the giant screens that Avesco specialises in hiring out. You just see them everywhere now, don't you? Look at the number of festivals that are going on in Britain now. Every pop concert seems to have a giant screen. They're just becoming much, much more widely used, Britain and globally. So I think again, I don't think you necessarily need to have numbers on that. I just think it's good to be generally investing in a where the theme is that we all know it's growth, not contraction.
I think that's quite problematic because that tends to make me wary because lots of companies can start piling into the latest hot sector. Like care homes about 10 years ago, that was a hot sector. The demand is going to increase and it's been an absolute disaster because too much supply came out.
Fair point. But again, I just think it's still better than a sector that you know is in decline, like newspapers. You know.
And we're looking at the theme of takeovers, so theoretically we're thinking maybe 1 year, 2 years ahead of the map. So in effect, you want something that is going to be relatively hot, because then somebody will want it from you. You're not going to be in it long enough, hopefully, if you're looking for the takeover, to worry about the downhill bit.
I mean, I'm not saying any of these are individually, you know, black and white. I'm just saying they're factors that I think are generally interesting. Now, again, not a chartist, but I think charts that are making new 12-month highs, that does tell you that something good's going on. It could be just purely a speculative bubble if it's a blue sky stock, but if it's a fairly boring sort of profitable dividend-paying stock, I actually think making new 12-month highs is quite an interesting area to look. It's, as value investors, it's not really what we want to be doing, but I think equally if you look at new 12-month lows, you just end up buying absolutely rubbish companies where everything's going wrong, you know. So yeah, again, restructuring is just a great investing theme. I mean, a lot of companies, say for example Flybe, seem to be constantly restructuring and they never quite make it, you know. But, so again, it's something that we have to be a bit careful about. But I do like situations where you can see a fairly obvious and simple way to restructure and boost profits, like closing down a loss-making subsidiary, for example. So that's a nice theme to concentrate on again. Yeah, broker forecasts, often too pessimistic at improving, growing smaller companies. What I find they often do is they say, okay, I'm going to forecast turnovers up 15%, and so profit will be up 15%, and they forget the operational gearing. So also, I mean, particularly where a company has had problems, the brokers are usually very reluctant to forecast aggressive improvements. So I think you can, again, I would never take the broker forecast as gospel. I look at them as a starting point, and then with Avesco, I wrote in several of my blogs over the last 2 years, look, the forecasts are way too low. And then shortly afterwards, you get a trading update telling you, yeah, we're going to thrash the forecasts. And companies that have said 3 or 4 times, we're going to thrash the forecasts, are the sort of companies that you tend to do it again and again, I think.
Don't you tend to find as well that basically the management will always want to beat the forecast?
Yes.
So if they're in a growth company, then they'll kind of be really cautious,
yes.
And then all of a sudden there will be this big surprise.
And I think it links back to the ownership structure as well. Remember, this is an owner-managed business, effectively. It's really a private company that happened to have a listing. They just have a different mindset from hired hands who own 0.5% of a company, who just want to get the share price up, cash in their share options and bugger off. You know,
the point though, Paul, that if this Richard Murray guy's been there since the start, all this restructuring, must have been restructuring problems that he'd created previously.
Yeah, fair point.
The Donald Trump thing, that how successful were you?
Yeah, fair point. So, yeah, off the radar companies I like. Every now and again, I mean, we've got, 1,000 shares on AIM and several hundred more fully listed companies. So we've got probably 1,500 to 1,700 odd small caps to look at. Below 100 million, you get very little interest from the city because they can't buy into them in any size that's worth having. So within that, I always find that if you dig enough and you put in the hard work reading all the RNSs, researching all these things, you do find some terrific bargains every now and again. Off the radar companies particularly, it's noteworthy how few RNSs Avesco put out. I mean, last night I was going to look through sort of 4 years worth of RNSs. I was sort of just dreading it, sitting down to it, but it was only 1 page on Investigate. It was incredible. There were so few. There were hardly any holding in company RNSs. The shareholder base, the major shareholder base, was just completely static for this company. There's no financial PR, so if you look at their RNSs, at the bottom, it gives the contact details. You'll just have the management and FinCap, no PR company. Again, that's good because it means there's nobody out there ramping the shares, which means they're probably more likely to be undervalued. And obviously the downside of all this is the illiquidity. These things were really tricky to buy. I had to spend 2 or 3 months just nibbling at this share, which is very inefficient in terms of broker commission, and it's frustrating as well. You want to buy the share, it's cheap. So just having to wait and buy 1,000 shares here, 1,500 there, if you can get them, is a real pain, and it puts off a lot of people. But in a way, I think you could flip it around and say that's maybe positive because it means a lot of people will not bother buying the shares. So going back to Stockopedia, I thought I'd go back and look at 3-month intervals, what the stock rank was. So stock ranks, for those of you not familiar with it, it's a rating between 0 and 100, basically based on all these algorithms centering on value, price and forecast momentum, and quality. So measures like return on capital employed, return on equity and operating margin. And it puts them into an overall rank and ranks every share in the market. And it's now proven, it's been running since 2012, and it doesn't guarantee success in any one share, but it's proven over 4 years now or so that each decile significantly outperforms the ones below it. So the shares that should be going up and doing well, as a basket of about 20 of them, do outperform quite significantly. So anything I find with a stock rank over 80 is really worth looking at. And in this case, the Stockopedia computers really did pick up on it just at the right time when the broker upgrades was first starting to happen. The value metrics are extremely low. And look, it stayed at an extremely high stock rank all the way through. So kudos to the Stockopedia computers there, I think. They did a good job. So, right, final thoughts. Did we own enough? So backing the winners. I mean, I'm increasingly coming around to the view that the big money investing is really made from concentrating your money into very oversized positions when you're onto an absolute surefire winner. Now, obviously, everyone's going to throw their arms up in horror and like that and say that's totally against what everyone says about diversification. And I don't think it's something you should do if your percentage hit rate is not brilliant, you know. But if you're generally improving and getting to a point where you're getting most stock picks right, then I really do think concentrating the money into the winners is the right sort of strategy for experienced investors. But again, it depends on age and income and lots of other factors. But really
Avesco had good downside protection because there was a very low P and asset backing.
Exactly, yeah.
Whereas if you were, it would be very risky to pile into some stocks on a P of 30, 40, 50, even though they look fantastic at the moment, because all of them can go wrong.
Yeah, no, I totally agree. So, I mean, I think probably this is more for value type shares. I mean, you hear some disaster stories. There was a guy who lost, 5 million or something on Quindell, I think, wasn't there? And
Rob Terry, was it?
But, you know, so, I mean, that's obviously treat that remark with caution. That's just my personal opinion for where I am in my investing journey. Best share ideas may already be in our portfolio. I mean, I cover 500 or 600 stocks in the morning reports, and I find myself just flitting about, constantly reading up on lots of different companies, and very often I don't see what's under my nose, which was certainly the case with Avesco. I mean, it was my 8th biggest holding out of a portfolio of about 40, and I'm really scratching my head to wonder why it wasn't in the top 3. Because, as you can see from the blog posts, you know, I've been absolutely raving about it.
Well, you couldn't buy them, you said that's the problem.
That was part of the problem, yeah. That's part of the problem. I tell you another thing, though, was I do everything in either a SIP or through spread bets, so the whole thing's tax exempt. And IG, it was closing deals only, so for several years. So, unfortunately, most of my money's with IG. I couldn't buy any through there, so I had to ram them into a SpreadX account. And generally speaking, if you do use SpreadX are the best by far for the small caps, I find. They're totally flexible. They'll let you take a position on anything. Anchoring to the share price is a big mistake. Yeah, so this is really when the share started to move. Again, looking back at some of my blog posts from 2014, I think it was, I was coming umming and ahhing about top slicing when it had gone from £1.30 to £2. Because you sort of anchored to that £1.30 price. Then some good news comes out, it zooms up to £2, and you think, oh yeah, I'm quids in. But of course, and then you had that long period where it just went sideways. But actually the value, as we now know, was substantially higher. And I think a lot of people, unfortunately, sold out of this one just through boredom.
If I could say something on that, what I tend to do is, even if I start off with something where it's a relatively small percentage of the portfolio, unless it becomes horrendously big where it's a risk for everything falling down, I kind of try to let the market just decide what are the good companies and what aren't. So effectively, you know, I've had stuff recently where it can double and then I'll just leave it. And originally it might have been like 3%, it's now 6%, and that's fine, and I haven't top-sized it at all. But if I'd had 8% in that and it was now 16, then I'd be quite worried. So I kind of almost try to run the ones which are going up, and then the ones which don't do anything or fall back, I don't top up on.
I mean, everybody's got their own strategy, but I to pick up on one point you made, certainly I think there is an issue where if you put, I mean, I tend to concentrate a lot into my best ideas to begin with, and if it then, you know, like with Boohoo, I mean, I had a ridiculous amount in that, and then when the well, for me, but then when the Brexit thing came along, I panicked and sold about half of them or 2/3 of them. It was a terrible mistake. But yeah, if it gets too high a percentage of your portfolio, it is a problem, isn't it? So okay, most expensive words in investing. This is the last point. Everyone always says, "Oh, it's different this time," don't they? Well, I beg to differ. I think from all the people I've spoken to lately on lots of different stocks, I think the most expensive words in investing are these. I've missed the boat, because loads of people I know have said on Boohoo, on this one, on lots of other brilliant stocks that have done terrifically well, you know, they've missed the initial 50 or 80% move, and they just, I'm not going to buy into it now. Whereas actually, after that first big move, providing it's based on really significant news flow and the fundamentals of the company totally changing for the better, I think we should embrace the fact that we're paying more for something that's improving and is on the way to great things. So that concludes my my little presentation.
Any of you got any questions for Paul, maybe, or comments?
What was the exit PE, and would you have bought it on that prospective exit?
Good question. I think the current forecasts are around 27 to 30 p EPS, but that's, I think, is prior to upgrades from the impact of the dollar earnings. So I think if we add on maybe 10 or 15% for that, probably would have been about 35 p EPS. So yeah, it's late teens, isn't it, the exit multiple? Would I have bought at that? No.
And that kind of leads on to a question I've got, which is, this multiple was a bit of a surprise, really. And do you think that was because of the large shareholders, how much they held of it, and the fact that it had been performing so well? They might have thought, well, if we have this another year, we might get it to 500p anyway. So.
Yeah, definitely. I mean, you could see from the slide on the CT figures going from break even, 4.5 million, 9.1 million, with dollar earnings and everything else. This year it's probably going to be 12, 13 million from CT. Yeah, 124 million takeout. It's not an excessive multiple for the best bit of the business.
Yeah. And the buyer could have cut out the CEO's salary as well.
Yeah. But I mean, you know, directors owned a third of the company, so yeah, they're gonna decide whether the deal happens or not, aren't they? Which is one of the great things about these family-controlled companies, providing they're straight. You know,
maybe there was more than one bidder, and they just
could be.
But you could also have to be disclosed though if there was more than one bidder.
Well, I mean, the document says that the 57 or 59% irrevocable you know, undertakings are still irrevocable even in the event of a higher competing bid. So it looks to me like they've negotiated a deal where they've just said, right, you know, pay top whack for it, and it's guaranteed to happen. That's my reading.
So that would be if someone else comes in with a higher offer, they still won't sell to the higher offer.
Well, supposedly, but I mean.
Is it a conventional bid or a scheme of arrangement?
I think it's a scheme of arrangement.
Scheme of, oh, well, that's
It looks like a done deal. Reading the RNS, it's so detailed and so full of all the legal stuff. You know, it's presented as this is going to happen type of thing.